Gentlemen, interesting times for the mining industry. Possibly a bit of a slow start for the year, but over the last couple of weeks, a number of deals starting to emerge in the industry, both in M&A space, possibly in the battery materials space, showing some interest there. Let's just start us off by giving us your thoughts on how the industry is and where we're going from here in 2019. Neil, do you want to kick off?
Thank you. I was just thinking about it on coming in on the train this morning from Leicestershire, and I thought, God, I'm just going to sound like a stock record because I feel like I've been on there. Okay. Well, I wasn't thinking about turning the microphone on. Sound like a stock record because I've been on these panels at one-to-one and others a number of times and seem to be saying more of the same thing. Although, yes, I guess there are, if equity investors and retail institutions are not interested in the sector, yes, we are seeing some signs of some corporate interest, but still at a very early stage. But obviously Lundin Mining and the Chapada purchase, the news last week with St Barbara and Atlantic Gold. So hopefully that's a sign that the corporate sector, the corporates are finding value and are starting to move. I think, in terms of generally on institutional investors, unfortunately it's still more of the same thing with, our generalist fund managers just wanting to see those cash returns. So don't build anything, don't buy anything. Just pay out dividends and do buybacks, and you saw that reflected over recent weeks when Fortescue announced a large increase in its dividend. The stock price reacted. Okay, not the mining sector, but when Gazprom announced a large increase in its dividend, that stock went up 20%. So I don't think that's changed much from the institutional side, but yeah, hopefully we're going to see some more M&A through the year.
That the equity investors, the institutions saying don't build, don't buy, give us dividends. That's creating the next boom. Yeah, it's creating another supply side squeeze.
Yeah, I mean, obviously every company and every commodity always has the crocodile jaws of widening of not enough supply and sufficient demand. So yeah, I think behaviourally you sort of think, well, it probably will result in shortfalls, and then ultimately these companies will start being more aggressive, but they'll be doing it when copper's, say, at $4 a pound, not when it's $3.
Sure. Colin, one of the things... Oh, welcome, Cailey. Can we get a microphone for Cailey as well? That'd be great. Colin, one of the big things that everyone's been waiting for, I guess, this year is the resolution of the US-China trade war. I think, in the last couple of weeks, everyone was expecting that to be resolved, and then it wasn't, and it went very much the other way. What's your take on how China is performing and the impact going forward of the US-China?
Thanks, Leo. It's a very interesting question, because even if we look at the past 2 weeks, the physical market is telling you one thing, and financial markets are telling you something else. Give you an example, the iron ore price is up about 7% over the past 2 weeks. The copper price is down about the same amount. Now, on the whole, what we've seen is a reaction from China whereby, look, when there's trade friction, they go back to the old school measures of priming the pump pretty hard. We've seen aggressive fiscal spending through the economy, and we're now feeling that lagged impact, if you want, from the spending we saw last year on the infrastructure side. And the property market's actually doing okay. If anything, and that was my area of concern at the start of the year, but if anything, property transactions, which are up about 57% year on year a couple of weeks ago, if anything, it's doing too well. Now, there is concerns there. I mean, from a macroeconomic standpoint, from an asset allocation standpoint, commodities, particularly the industrial commodities, are always going to be out of favour in an environment where we saw escalating trade tension. Now, I talked about that copper-iron ore disconnect. We saw it last year. Now, historically, when you get these physical financial disconnects, they last a month or so. Last year, it lasted 6 months because we had continued escalation on the trade side. And that is going to be an overhang at the current time. Now, from a fundamental point of view, if I'm looking at it, if anything, I'm slightly upping my demand figures for this year because China's doing, certainly on the steel side, well ahead of what I expected. It's having an interesting second-order impact. Europe is the weak area in the global industrial economy at the current time. I say China's doing pretty well. Okay, the strength in industrial production we saw in March hasn't been sustained, but it's still okay. I think there's a big push from Chinese consumers to buy China at the current time. Just to give an anecdote on this, if you go into a consumer goods store or a white goods store in Shanghai at the moment, you'll find the Chinese brands are at the front and the European brands are at the back. That's the opposite from what it was 6 months ago. So I think it doesn't affect my overall balances, but it does affect where First Metal is consumed. I think you're seeing, as I say, Chinese consumption of many of the commodities we look at is actually doing slightly better.
Right. And what is the capacity of the Chinese government to do more stimulus spending, do you think?
Yeah, it's a good question, because they've used up a lot of ammunition, actually, over the past 6 months or so. Now, they've always got wiggle room they can do. The one area we're looking for now is the auto stimulus. We've been waiting for it. I think they were trying to hold that off until the third quarter to give kind of a little bit of a top-up stimulus. If they're getting more concerned, that could be something we see brought forward into the next month or so. So they still have some ammunition, but it's, I say, they've used an awful lot trying to get that impulse through the economy. Bear in mind for China, very important for them that to meet Xi's promise of doubling per capita income 2020 over 2010. I think they will be continually putting money towards that to try and make sure that happens.
It's interesting you said Xi's promise there. I mean, Belt and Road is another thing that gets mentioned a lot, and obviously that is his big legacy policy. Are we going to see more of a push for companies in China to get out there and do investments?
So it's an interesting one. I mean, in terms of the actual Belt and Road policy, it's going a little bit in reverse now. Number one, they've got less ammunition to fund it, and they've met with a bit of resistance in certain areas, Malaysia, Pakistan, for example, about how they're doing it. However, I do still think that, I mean, China's commodity business model is to go and secure raw materials wherever they may be, and with a Chinese domestic mining industry, which is under continued environmental pressure, look, seeking out good quality resources overseas is still going to be part of that agenda.
Certainly at our Hong Kong conference a couple of months ago, all of the Chinese SOEs speaking on the panels were all saying that they've got money and they're looking to buy stuff at the moment, mainly in the gold space, which is kind of interesting, which tells you something about the economy. Charl, view from New York and Van Eck, obviously, you know, global outlook there. What's your take on the industry right now?
Yeah, sure. We've got a couple of different views, and we're trying to get companies to do a couple of different things at the moment, so let me share those with you. First of all, it's a global fund. It's sort of a mixture between what I would call metals and mining and energy. And so we've all seen this capital return that Neil spoke about a little bit earlier, and we continue to drive companies to return capital to shareholders. We are seeing a lot of the, I would call, larger mid-cap non-gold companies experiencing a lot of pressure to start growing their supply base. So that's sort of one of the pressures that they are seeing that we are trying to get them not to do. One of the reasons why we don't want them to do that is we believe for the generalist investor and for their multiples to start re-rating, we need some consistency and some delivery. And the consistency and delivery, we believe, is good financials, promise what you're going to do, which is keep your debt low, strong cash flow, and return that money to shareholders. On the gold side, we are obviously seeing some M&A activity, some large M&A activity. And we are pro M&A activity in the gold space, mainly for the reason if it makes strategic sense and there is efficiencies to be gained, then that's a good idea. Otherwise, we're not actually going to be supporting those types of things. Part of the reason why gold is most probably going to be more M&A activity than the non-gold is there's just a shorter life of mine equation built into those space. The other reason why we're trying to keep the cash flow story going and the return to capital shareholders going is we are doing a real hard push on the energy side of our fund into our energy companies and saying to them, look what's happening in the mining space. Look at what they've done. They've restructured. They're more efficient. They've reduced their cost. They're returning capital to shareholders now. Now it's your turn to start doing it. And for those that follows the energy space closely, especially the mining, excuse me, especially the energy space in the US closely, you would have seen over the last quarter or two a lot of the management starting to talk about returning capital to shareholders. And that's the type of thing we want to get. And we believe that's what most probably will get the broader base US investor back into the space.
Okay, you mentioned there some of the mega mergers. I think at this conference last year was just after the Randgold Barrick merger, which seemed to get quite a sort of negative reaction from the panel, I think. Since then we've had the Goldcorp Newmont merger. What's your take on those two big mergers? How have they played out? Has it been a good result for the companies?
Well, I guess for us, from a Barrick point of view, is that being one of the biggest shareholders, we have a lot of confidence in the management team and the management being able to execute what they've delivered before in Africa, and we believe that they will continue to do that. When they were talking about the big merger in Nevada, well, first of all, there's a big merger, and then there was a joint venture. So if you look through the press publications that we've written over the last month or 2 months or so, we were initially against the big merger within those two big companies, purely because we didn't see naturally the synergies being in there. But once they started talking about a joint venture, i.e. just really extracting the few synergies that we do see and not doing a whole big merger, we started to get more positive on that.
And going forward, we just, one of the deals, Atlantic Gold with St. Barbara was mentioned earlier. Is that a trend we're going to see more of, particularly that sort of Australia going to Canada play, whereby the cashed up Aussie miners are going to buy some Canadians? You look like you've got a...
I'll contribute on this because our equity team actually wrote a note on this last week. And I mean, yes, given the multiples that we're seeing trading on, and it's part of the function that the Aussie Golds have done well over the past 2 years. Therefore, some of these Canadian mid-cap golds actually look cheap on a multiple basis, and therefore we are seeing that trend coming through. It's interesting. We're only still, I think, in the early stages of this gold M&A trend. We're seeing the mega mergers, as you mentioned them at the top. You see assets shaking down into the mid-caps. You see mid-cap consolidation. Why is this happening? The gold industry needs to be more relevant to generalists, and that is part of the challenge. And this is only going to help that process. Look, gold price is a function of capital under management globally to a certain extent. Your marginal buyer of gold these days is a multi-asset allocator. Honestly, they don't have to go to the effort of understanding a gold equity. So therefore, I mean, of that portion of capital under management 10 years ago that had to go into gold equities, now it goes into the ETFs and it can go into the options market. What we're having to see, therefore, as I say, consolidation to make these, to make gold equities just interesting enough to try and pique the generalist attention.
Did you remember to include that list of Canadian companies I sent you, Colin? Yeah, I mean, I think the merger of sort of takeover of Goldcorp by Newmont and the other one, the merger of egos, we call it, has left an opportunity for a sort of growth mid-cappy gold stock, providing it's done at the right price. I mean, I don't know Atlantic Gold well, because unfortunately we weren't shareholders. I hope it works out better for St. Barbara than their Allied Gold transaction. But yeah, I mean, we probably said this last year and the year before, but finally maybe we will see, or we should see more of this.
Cailey, let's bring you in here. Your take on the year ahead and how the mining industry is faring at the moment.
Yeah, thanks, Leo, and sorry for being late. Well, I think it's a very interesting time, isn't it? I mean, just generally, we're sort of one tweet away from the world moving into one direction or another. And certainly the only thing that's apparent is there's a lot of uncertainty and a lot of nervousness in the markets. And we've seen that, numerous times just in this year alone. Mark Cutifani sort of quoting that the platinum space was a bit of a bubble, or misquoting perhaps, and knocks $30 an ounce off the palladium price is sort of evidence to that fact. I think, we're mildly confident that things will play out okay in the end, but I think it's going to be a lot of a bumpy road along the way, and I echo a lot of comments from Colin in regards to copper and iron ore. I think we are going to see this trend of this sort of bifurcation trend that we've had between the juniors and the big guys. I think that's going to continue, in all honesty. And that's partly driven nothing to do with what the mining companies and us as investors can do. It's more to do with the sort of marginal retail investors and where their interest lies. And what we've seen is a massive reduction in liquidity, particularly of junior and even mid-cap stocks. In fact, I would say the only liquidity is in the large cap stocks these days, which makes portfolio management a real challenge. You can buy something, but you can't get out of it, and perhaps it takes a long time to even buy it. So I think that trend's going to continue, and I think actually it's going to be a real challenge for a lot of the junior companies in general, and perhaps the mid-cap companies. So in that regards, consolidation does, when there is real synergy, there makes a lot of sense. It's just a question that has to be in what sort of shape or form, and how they come about, and that's perhaps going to be interesting to see. I think yes, indeed, certainly the Australian guys will take a bigger look at Canada as they have been doing. But we've seen, when they entered into Africa, I guess, into the 1990s, 1990s, I'm going to say, the likes of sort of Resolute going into there, and the first early movers into a new continent was not without its challenges. So I think it'll happen, but it'll be a slow and quite volatile inroad into new areas. And we'll just have to see how those sort of play out. So, there's going to be good ones and there's going to be bad ones, quite frankly.
A theory that's been floated, analysis of this situation that was floated at one of our conferences recently, was that there is a difference between Australia and Canada, whereby the Australians, the attitude seems to be to get a project into production as quickly as possible and to start generating cash, whereas in Canada they tend to drill more holes and go for a bigger resource without necessarily getting it into production, which in a situation where the equity markets are beaten up, creates opportunities for someone with cash to go and actually buy a new resource in Canada, for example. So that's why the Australians are looking at Canada. Is that something that sounds reasonable?
Yeah, absolutely. I mean, the Australians I think the Australians generally are very good business managers. They tend to try and follow the idea of making cash. Obviously, the Australian gold price in particular has moved in their favour. But that's been very much their model. I would say the caution to that is that can lead to a certain sort of, dare I say, arrogance that you can replicate the same business model in other areas, and it's never quite as simple as that. I think when you do move into new areas, expectations are different, work cultures are different. And you do need to blend into these areas to try and do something, replicate something similar. It's rare that you can see the same business model from companies rolled out across different jurisdictions with initial success straight away. But it's certainly they're an excellent example to follow. And making money, returning money to shareholders, it's not that difficult a model if you can follow it.
How long do you think it'll take? And this is to anyone on the panel really. For this policy of returning money to shareholders to sort of re-engage the investor community? How much money do you have to return to shareholders before they go, actually, this is a good sector, let's get back in?
Well, I'll kick off with it. About 3 years ago, we started talking to our investors and our investment base about this potential return that's coming, right? And now we're there. And we are not getting people saying, we want to buy the space because there's a return on capital, call it a dividend story, dividend yield story. We're not getting it yet. End of last year in October, I did a big trip through Europe here, and I'm not the specialist on Europe here. And the same thing, same story to people. This is what we're seeing. Look, we're now into a number of quarters into this, and yet the investor said to us, that looks great, but now we've got this macro overhang on us, whether it's the trade deal or not a trade deal, but we've got a macro overhang. So for me, I feel that despite the great fundamentals and valuations that these companies have, there consistently seems to be this thing that makes it easier for investors to go somewhere else. And if you really think, I mean, Cailey brought up something a little bit earlier about just pure liquidity, if I can go back to that for a second. I mean, liquidity is a big story, but liquidity becomes a bigger story when you start getting ETFs involved. Now your ETF, and if you think about the ETF manager that manages that ETF of his engagement with management period is non-existent, right? So the ETF guy that votes on a proxy has never met management, must probably never read the thing. He just uses a consultant, and the consultant votes on his basis. So for us as investors to really get into that small, low liquidity thing becomes a gigantic risk in an environment where we are now, where investors are already saying to us, why should we be in this space? It's difficult for us to put our hands up and say we will go down the market cap scale.
Absolutely.
I think it's an interesting thing for the mining cycle as a whole. We've had and if we think everything tends to come from the big guys, and we've had the major diversified miners in the main making lots of money, but also funding outside shareholder returns by sales of non-core EBITDA, by cleaning up the portfolio. There's actually limited amounts. I mean, there's not much left effectively to divest. And then it comes down to the fact that then they become ex-growth. Now, that might be the point where you start to see, well, where does growth play into the equation? Just being flat or being negative growth isn't that attractive. So maybe then that kicks off the cycle. But we've been waiting for that for 2 or 3 years now.
I guess the private equity investors and the sort of the streamers and people like that must be rubbing their hands listening to this tale of gloom that you're painting here. You're creating fantastic value opportunities, I guess, in the sector by this sort of slightly negative sentiment. I guess they must be queuing up to scoop up some cheap opportunities.
Well, I think obviously not an area that I know particularly well, but they've also, a number of the PE groups have had problems as well with, assets or mines not working out as planned and have lost a lot of money. So I think it's a difficult space for them as well. And I think the other problem is they go around and say, well, we want, low cost, well managed, good jurisdiction. Well, so does everybody else. So there's a lot of competition. And even in 2015, copper assets went for a decent price. So if you want to get something that's really good value, there's no way getting around the fact that you're going to have to take risk. The cheap assets are the ones that aren't developed, that are not funded, that are not permitted. But there's obviously little sign of interest in those as yet. Yeah.
I mean, one area we've seen this possibly start to happen in is the battery materials space, right? With, was it today? There was a Bacanora announced a deal, and we had Kidman Resources a couple of weeks ago getting bought out by West Farmers. At our Singapore conference last week, Alliance Mineral Resources received a big investment from Galaxy. That sector has been, pretty beaten up over the last year, and now you're seeing people seeing the long-term outlook, demand outlook for EVs looking pretty strong, buying back in. Is that, Colin? Cailey, what's your thoughts on the battery space?
Yeah, I mean it's exciting. I think on the longer term, on the short term, we're still working out what on earth it's all about. Quite frankly, we still don't understand battery chemistry and where that's leading. The markets are moving in all kinds of directions. Generally, EV auto sales in China are looking pretty good against the backdrop of very average overall auto numbers. So it's meant there's been a lot of froth and interest in the space, which is probably come out in the last year. I think over the longer term, the trend, it's a question of sort of penetration rates and all the rest of it, but I think over the trend over the longer term looks fantastic. I mean, we've launched, this year we launched a Future of Transport Fund, which invests across the whole space, right the way from the battery materials right down through the tech OEMs and into the technologies, which is because it's part of this, new thematics. These things look exciting, and there's lots of other sort of themes that people latch on to. I think you have to just be a bit brave about it and look through the sort of short-term cycles that happen, because I think this sort of trend as we're seeing this year, it does look very tough, but I think it's inevitable that at some time in the next decade, we will all be driving some kind of electrified cars. It's just a question of how we get there.
And I think the key point is it's a sector where you can see growth. Say we're in a world where, from an industrial standpoint, people are getting very negative about what happens potentially over the next 2 or 3 years. But this is still a thematic where we're going to have to encourage 10% more supply to the lithium market every year. So there will still be opportunities there. At the moment, I mean, with the China subsidy policy, that is a lot to answer for in terms of what's going on in that sector. We're going through a consolidation phase in China and the downstream side, and I'm sure you'll hear more about it at your panels in the next couple of days. But the growth side is what makes the battery raw material side stand out. But to Cailey's point, we're all still learning about it. Everyone's now an expert, having looked at it for 2 years. It's definitely an area where you will see more and more interesting stories come out.
Absolutely. Charl. Yeah.
Interesting meeting that I had about 2 weeks ago. An individual that I became acquainted over the last couple of years that's very involved in the natural resources space in Washington, D.C. He works for a think tank there. Came up to come and meet with me and, excuse me, I guess other investors similar to us. And the American government's biggest fear at the moment is basically that they will not have security of supply. Whatever that electric vehicle commodity is going to be. So the American government are very actively looking and very actively researching this space to create opportunities, to fund opportunities, to allow opportunities within the continent or within the country, so that the US can have its own security and own supply base. They are extremely concerned about what's happened with China, what's happened within Africa, that they eventually will not get anything and they will not be a key player within the space and won't be able to drive that future development.
Are you familiar with Erik Prince? Yeah, Erik Prince was founder of Blackwater, Trump supporter. His sister is Betsy DeVos, the education secretary. He's currently setting up a $500 million battery materials fund. He's very closely tied with, involved with the government and with the CIA in the past and things like that. So it seems like that plays into that thesis that America is very keen to secure supply. He's looking at projects in Africa, investing in projects in Africa, and getting hold of those battery raw materials. Do we have any questions from the audience here? We've got a question at the front here from Claude. Can we get a microphone down here? Is it switched on?
I heard that Van Eck had decided to go out of junior small caps. I would like to know what the portfolio manager thinks about this. Does this mean that you believe that junior stocks are going to underperform in the long term, although there is value and growth? Or is it a marketing stunt to boost the fantastic success of GDX? Or is it the typical contrarian indicator, just like Sprott went out of small caps at the bottom of the market in 2015?
So a number of answers to your question. The first answer is, or the question is as follows. There's a number of different products that we provide to our prospective investors. The True Global Natural Resources Fund has a liquidity problem going into the smaller cap names, so it's a liquidity reason. Our truly dedicated precious metals fund, think of it as a gold fund, that goes down the market cap as low as a couple of $100 million. The reason why we go down that far in the market cap, because we can do it. It's a very specific, dedicated fund for that space. And the investors that typically is within that fund is buying it knowing that it's a much longer term structural investment, and they're buying it for an environment of less growth or lower growth or slowdown in growth. And then the third point, which is what you referred to when you talked about, is that's the ETF space. So we have a very big ETF business that I'm not directly involved in, and we're not going out of that space. the inclusion of a company within an ETF, whichever the ETF is, depends on various parameters that have been set up by the index creator. Depending which ETF you talk to, it could be your revenue from a certain commodity. It could be your liquidity number. It could be your production number. There's a whole range of different numbers that we've got a number of different mining ETF or resource ETFs, and they're all different. So per se, we're not stepping out of it. The only place we are stepping away from it is purely in the big in the big global fund, and it's purely a liquidity reason for that.
Fantastic. Any other questions from the audience? Put your hand up. We've got a question here from Rick.
Thanks. Just curious on gold, focusing on gold. I think it was last week or the week before, one Trump tweet caused the copper price to come off, gold price to go up, and then another couple of tweets later, we've seen the gold price come off, and the copper price probably come off a bit more. But in the middle of that, Bitcoin doubled. Gold went up, I think, 8% or 3 or 4%, something like that. But Bitcoin doubled, and gold's come off significantly, but Bitcoin's held up. Just curious if gold's lost its shine or what's going on there.
Yeah, so I call myself a Bitcoin specialist. In terms of the gold price, I mean, gold is a big liquid market. Bitcoin, quite frankly, is not. So the gold price is moving a lot with US dollar, which is when we've seen US dollar strength, we have seen copper come off and gold come off at that point. There is a bit of portfolio rotation, I think, back towards gold, given the fact that we've gone into a bit of ongoing trade tension. But let's be clear, I mean, gold at just shy of $1,300 US dollars an ounce. I mean, almost record levels as we talked before in Aussie dollars. It's a pretty good price, and actually to be relatively stable at what is a decent price is not necessarily, I think, a bad thing in these markets. So in terms of gold, I wouldn't say it's lost its shine. I think it's still getting its annuity from portfolio allocation. It's just there will be slight cycles around that. Look, if we go into a big risk-off environment, you'll see flows into gold, but gold also will fund any move risk on. So if we see a trade resolution, don't be surprised to see the gold price, of course, come down in the short term. Look through the longer cycle, it's still a function of global liquidity and also, I mean, global monetary policy, which is still pretty loose, actually, at the current time.
What is our panel's thoughts on gold in general? It's a commodity we haven't really touched, or a currency we haven't really touched.
Yeah, I think pretty positive, actually. I mean, if you think about last year in an environment where, oil price was down 25%, base metals were down by nearly 20%, and then those traditional headwinds of a strong dollar and rising US interest rates, essentially gold was flat. So I think last year, not so much gold equities, but gold bullion performed really well. And I think in this sort of, with the foot off the interest rate increase pedal a bit, I think this prospects are good. And obviously after the pullback we had in many share prices in the gold sector, I think there's plenty of opportunities out there.
With the trade war continuing and US sort of consumer goods prices likely to rise, is that going to lead to more inflation in the US and then sort of maybe interest rate rises and things like that? What's your take on that, Alex?
Well, I think you would think so. Yes, I think it is largely predicated on inflation expectations and also how the Fed deals with that in terms of interest rates. So you have got this sort of interesting dynamic. I think generally it does look very positive. I think what they're less concerned about the gold price. They're more concerned about the broader markets. And that's been on a tear for such a long period of time that it's a question of when will we see that roll over? And maybe it's this year, maybe it's next year, maybe it's 2-3 years, maybe it doesn't happen. Who knows? But I think that's perhaps the opportunity for gold as a hedge against that in its own investment class, and that's perhaps the best place to play your bets, I think, if you are worried about the broader markets.
Mm. And then, of course, if the trade war and all that uncertainty leads to a fall in the stock markets, we might see some money flowing back into hard assets. Yeah,
we'd hope so.
We'd hope so. Any final questions from our audience? Feel free to pop your hand up if you've got one. If not, I'm going to ask our panelists to give us their sort of commodity, or you know, we could go with type of company if you'd like to go that way. Sort of, you know, the sort of type of investment you think will work over the next year. Charl, should we start with you?
Sure. I'll just make a comment again on what Cailey said before. Is I think the big thing about the US market that people don't necessarily realize is if you think about the broader Dow, S&P, whichever broader sector you look at, in general the space is down. There's only a couple of stocks, Amazon and Netflix and whatever else there are, that's been keeping the market up. Right. So it's not like we need this broad rollover for that to happen. So I think we're closer to that than what maybe we might realize or what we're thinking. I'm really interested in companies that is returning cash to shareholders, one thing, and secondly, I'm looking for companies that have got some type of a self-help, whether that's innovation, whether that's cost reduction, whether that's restructuring, whatever the case might be. That's the space I'm interested in at the moment.
Fantastic. Any examples you care to give?
I can, but I can only talk about the real big names that's publicly listed that we own, so I can start with those, because otherwise I will end up in a place that I'm sure you're not going to come and visit me. Anglo PLC actually stands out for me quite nicely in that front, and they talk about this future mining aspect and approach to that. So that's sort of the one thing that finds interest in me at the moment.
Excellent. Colin?
Given Chinese steel's doing a lot better than expected, actually the bulk commodities of iron ore and metallurgical coal are probably still undervalued a little bit over the near term by the market.
Fantastic. Neil?
I'm going to go for discovered but not yet developed Canadian gold projects.
Discovered but not yet developed. Excellent. Any examples?
Well, where it's public that we're a shareholder, hopefully there's a workout, Marathon, Cisco Mining, Barkerville, Integra.
Fantastic. And Cailey?
Yeah, I think echoing my earlier points, sort of big liquid companies are probably going to fare better. That certainly have a good policy of returning cash. But I do think there's also a place for good exploration companies, particularly if they're world-class. I think those will continue to do well if they have some promising results.
And favoured metal or mineral?
Iron ore is looking pretty good. I think copper will be okay, but that's predicated on how the trade wars and etc. play out.
Okay, fantastic. Well, that's the end of our time for this opening panel. That's a very interesting look at the sector. Can I have a big round of applause for our panellists?